Hey everybody, it's Ken McElroy. I'm here with my friend Tom Wheelwright, fellow rich dad advisor, tax guru, author of Tax Free Wealth. Hey Tom.
Hey, Ken. Good to be here with you.
You too. So obviously we're right in the middle of tax season. Well, first of all, thanks for being on the show during tax season.
No worries.
And so obviously this video is about how to help you with your 2020 taxes. And you guys need to watch this before you file because I'm telling you, there's a lot of things that you guys can do, and these laws are continually moving, right, Tom?
Oh, yeah. There were a lot of changes during 2020 and even into 2021. And this is the first year I can honestly say everybody is being affected, not just even the business owners, but everybody gets affected by these tax changes.
It's nuts. I know. I tell you what, it's confusing, especially with all the money that's being thrown at us. So, let's talk about, for those people that have claimed unemployment, do they claim that on their tax returns? We're actually getting a lot of questions around that.
Yeah, so that is taxable. And some people had withholding done on their unemployment, and they may even think that they're good to go, but their spouse may have had a good year of income. And so they may not had enough withheld. So even if you had withholding, you may still owe taxes. If you didn't have withholding, you're sure to owe taxes.
Oh, wow. Wow. Okay. So obviously, I mean, we're in this new time. There's a lot of people that got pushed home. They're working from home during during this pandemic. What do they do and what should they be doing about the write-offs for, because now there's a lot of people that were at their offices and now they're at home. What are some of the basic write-offs that people can get for being at home with their office expense, and how does all that work?
So Kenny, this is where, as you know, the tax laws is an incentive primarily for business owners and investors. It's not an incentive for employees. So this is one of those areas where employees get no tax benefit and business owners and investors get great tax benefits. So you're home now, you can't go into your office. You're an employee. There's no tax
Oh,
deduction.
wow.
You're just out of luck. But if you started a business, you own a business, or you're any kind of professional investor, then guess what? Now that home office, that's allowable to you. Now, here's the one thing, Ken, where people get mixed up and they say, well, look, my accountant said if I have an office outside my home, I can't also have an office inside my home. And that is not correct. Okay. You have to, there are very detailed rules on it, but you sit down with your tax advisor and say, wait a minute, I heard on Ken McElroy's program that I can have an office in my home and an office outside my home. How do I make that work? And that's the key question. How do I make that work? What do I have to do differently so that I can deduct my home office? Because remember, you have a home office, you get a lot of things. I mean, you get to deduct a portion of your maintenance, your housekeeping, your mortgage that you might otherwise have lost, your taxes that you might otherwise have lost. I mean, there's a lot of things you get to deduct. On top of that, home office typically increases your deduction for your car because now you don't have a commute. Instead of your commute's 30 feet from your kitchen to your home office, right? And so now that first trip you take, let's say you go see a property, you have to go into your regular office because you've got a meeting, your socially distanced meetings, right? Whatever it is, now those trips are deductible, where if you didn't have a home office, that wouldn't be deductible. That would be a commute.
Ah, that makes a ton of sense. So is there anything people can do? Should they create another business and do it like a side hustle, and or does that even matter?
Side hustles are great. You have to be in business. So if you weren't in business in 2020, you don't get the deduction for 2020. And there's nothing you can do after the fact.
Are you
Okay.
surprised I asked you that question?
However, let's say that you're a real estate investor and you have a couple of single family homes. You could have had a home office just for your real estate business. Ken, I remember years and years ago, I handled an IRS audit, and the client had a business in his home, and he was both a real estate professional and he had another business. the IRS auditor was really clear. She said, look, you should just put it all on the real estate side because that won't even be a question. Okay. So because that is your primary business office for your real estate investing. So I think that, being a real estate investor, as you know, Ken, has phenomenal tax benefits. This is one of them. You can have a home office as long as it's only used for your business and it's not, you're not playing games there. You're not, you don't have it's not in your bedroom, et cetera. I mean, it needs to be a completely separate space, but I'll tell you what, it's amazing how much you can deduct when you have a home office.
Okay. There's a lot of confusion about what is a tax or what is a real estate professional. And, I know there's kind of a gray area there, not to you, but for a lot of people. So can you maybe clarify that?
Yeah. First of all, so there's really two very simple rules. Okay. The first rule is you have to spend more than 750 hours a year doing real estate. Okay. That's rule number one. Rule number two is you have to spend more time doing real estate than all of your other businesses and jobs combined. Okay. So you could be spending literally 1,000 hours on real estate every year, but if you spend 1,002 hours at your job, you're not a real estate professional. It has to be your primary usage of your time, basically, is the real estate business. Now, the good news is it's either you or your spouse. You don't get to count each other's hours, just your hours, okay, or your spouse's hours, but only one of you has to be a real estate professional. So there are a lot of stay-at-home husbands, a lot of stay-at-home wives that, they don't have other jobs. And so really 751 hours is the key. And they can spend, that's only about 15 hours a week. So it's not a whole lot of time. And literally, if you go 20 hours a week, you're going to be pretty safe because 20 hours a week is about 1,000 hours a year. I would not try to hover around that 750 hour because what you don't want is the IRS coming and saying, well, look, I see 3 hours here that I'm going to disallow. And all of a sudden you're at, 748 hours and you don't qualify. Because remember, real estate professional is basically what I call your get out of jail free card. This is the designation that allows you to deduct your real estate losses, which are huge, of course, with cost segregation, bonus depreciation, et cetera, against any other kind of income. So against business income, against wages, against your spouse's business, against your spouse's wages, against interest income, dividend income, capital gains, doesn't matter. All of those losses from your real estate are allowed to offset any kind of income if you're a real estate professional. So it is a big deal.
Yeah. So I would imagine, so if you're filing jointly, and maybe there's one person, working and the other one's at home, and more than likely, if you have investment real estate, you're dealing with tenants, dealing with vendors, collecting stuff, all the things, even if it's on the weekend or in the evenings or in the mornings or whatever it might be, those hours can add up. So you're saying there's probably, I'm sure you see this, there's a lot of people that probably qualify for a real estate professional if they're filing jointly, right? And then their marriage gets the deduction.
Yeah, no question. Now, there's one other rule that I need to mention because it's critical. There's always a third rule, right? So the third one here is there's an election that your tax preparer has to make on your tax return. And basically this election says you have to combine all of your properties and treat them as a single investment. Okay, this is called the aggregation rule. If you don't do this, you probably aren't going to qualify. And the reason is because not only do you have to have 750 hours in real estate, but you have to have more than 500 hours per property.
Oh, I see.
Okay. And if you have 15 properties and you're spending 50 hours a year on each property, that's not going to qualify. But if you elect to group them all and kind of aggregate them, it's a very specific election on the tax return. If you elect to do that, you're going to qualify. And anybody who makes that aggregation election and has over 750 hours is probably going to qualify as a real estate professional.
Okay. And obviously there's a lot to this. And Tom, what's the best way people could reach you, for these kinds of questions? I know you have a ton of great stuff on your website. What's the best way?
So easiest is our website. It's wealthability.com. Wealth, just like the money and your ability. So wealthability.com. And we're happy to help any way we can.
Yeah, I know. I've sent a ton of people your way, and they always text me back, like Brad Sumarock. He's like, "Yeah, thanks, man. For I know you saved them a ton of money on the way that they were doing stuff." And so, guys, some of this stuff, even big real estate investors like Brad, you get moving along, and you don't realize that there's a lot of low hanging fruit there legally that you can do. There are things that you can do. I've been watching Tom do this for a long, long, long time. So, Tommy, let's get into the stimulus money and the CARES Act and all that kind of stuff.
Sure.
Because, I know you talked about unemployment. Do you have to claim the stimulus check too as income?
So that's an interesting one because the answer is really no. And it gets a little complicated, but if you got too much, you don't have to send it back. As a general rule. So for example, let's say that you got your stimulus check in July, your first one, and it was based on 2018. But then your 2019, 2020, you wouldn't have qualified. You don't have to send that money back. You get to keep that check and there's no impact on your tax return. Go the other direction. Let's say that you didn't get it because your income was low, was high in 2018, but in 2020, you had a tough year. Maybe you went on unemployment, your income, now you qualify, but you didn't get the check because you hadn't filed your 2020 return. Now you can claim that credit on your 2020 return and get that money today when you file. Okay. Now that also applies, by the way. So stimulus number 2, which was in December, right? So we got another stimulus check that went out and it was looking at 2019. Okay. But let's say you didn't get it. It's a 2020 tax credit. So when you file your 2020 return, you should get it. Now, one more little complication here, Ken, as if this isn't confusing enough. There's another stimulus package, right?
I know.
So by the time this airs, there may be a new stimulus package already passed. And so that one is going to be dependent on your 2020 return. Now, here's the thing. Let's say that you had a really good year in 2020. All right. I mean, I know, and you probably do too, Ken. I know as many people who had a better year in 2020 than had a worse year in 2020. So you had a really good year in 2020, your income's way up. Well, you don't want to file your tax return until after you get that next stimulus payment, because if you file your tax return early and you don't qualify, you don't get the payment. But if you extend your tax return, okay, past April 15th, and they send you the check, you don't have to send it back.
Oh my gosh. So you're saying this year everybody should wait until the very end?
Well, some people should, right? I mean, a lot of people should, because if your income went up in 2020, you should wait. If your income went down in 2020, you may want to accelerate that so that you do get the stimulus check, right? So it's really, this is one year where most people are going to want to use a professional tax preparer to help them, even if it's just, the guy on the corner, right? I mean, it's just so much complexity. Now, the good news is none of these credits increase your tax liability, right? They're tax credits, so they're dollar for dollar. And there are going to be times. So here's a good one for you, Ken. So let's say that spouse took the kids in 2019, you take the kids in 2020, you might both get the credit for your kids. So because one of you might have filed based on 2019, the other one filed based on 2020. But the good news is they're not taxable unless you got completely in error, like your spouse died and you still got to check. That one you need to send back. But the other ones you don't.
How do you guys stay on top of all this, Tom? I mean, it's like, I mean that, like, truly, I mean, as you know, sometimes you burn through professionals, different firms, and you've seen the best and the worst of it all. It's very common. I find people bring their stuff to an accountant, not you. And then they're like, oh, what do you mean I should have gotten depreciation? What do you mean I should have gotten the bonus depreciation? Like, what are some of the, what do you suggest? Because we're heading into all these stimulus packages, all these different law changes. And is this something that, it could be very expensive and you can get bad advice? Or what is something somebody should be doing?
Well, you bring up a good point, Ken, because remember that, people tend to look at their tax preparation as an expense. And so you're always trying to reduce expenses, right? Whereas if you look at your tax preparation, if your tax preparation becomes an asset, your tax advisor becomes an asset to you, you're not so worried about that cost, because what you want is a return on your investment. And I've seen a lot of it. I had a client tell me, he said, wow, your fees are expensive. I said, yes. And we saved you $2 million.
Right.
I'm going, choose, right? Choose. Do you want lower taxes, or do you want a lower tax return prep fee? You get to choose. But I'll tell you what, our clients, it was pretty funny, because it was, oh yeah, that's right. And it's just, but it's a tough thing to remember that, one of the things we're always talking about, Ken, I know, and with the advisors, is it's all about a team, right? It's all about building your team, and having the right team members is key. So in Tax-Free Wealth, chapter 23, I actually talk about how to find a good tax advisor. And a lot of it is kind of like finding a good doctor. I mean, if you go to a doctor and all they do is tell you about their diplomas, you probably need to, get out of there quick, right? And say, to quote Ken McElroy, next.
I do
And
say
then,
that a lot.
but the same thing's true with a tax advisor or a legal advisor, right? An attorney. They need to be asking you about you. They need to be spending most of their time diagnosing your situation, and not most of the time talking about themselves or their vast accomplishments.
Right. All right. So now we're going to jump over to the premium page for some bonus questions about what you should be looking for when you file your taxes. If you're not a premium member, go to kenmcElroy.com/premium and sign up. And guys, if you need to get a hold of Tom, or you want to go to his stuff and you want to take a look at his website, it's www.wealthability.com. He's got loads of information. Pick up his book, Tax-Free Wealth. He's got a ton of information on there. He's a best-selling author, Rich Dad Advisor. He does Robert and Kim Kiyosaki's taxes. This is the guy. Make sure that you go check him out. Tom, thank you, my man.
Hey, thanks, Ken.